even if you took an arithmetic price chart of silver and you measured from lows that were $4 and $5 during the last 50 years and highs that were both at 50, you've got like a $50 range there almost. Well, add 50 to 50, the breakout point, you got 100. So even on an arithmetic scale, silver should just go to 100 just to match the simple arithmetic scale. But I'm arguing on the log scale, it's likely to do that. And also reprice itself fairly versus its real dollar value. Remember, you look at an M2 chart and look at the massive increase in the money supply since 1980 or even since 2011. And if you try to match silver to simply match the decay in the real buying power of the US dollar, silver would be in the hundreds.
Silver has spent nearly half a century trapped inside a price structure that never reflected monetary reality. According to Michael Oliver's work, that confinement was not accidental, nor was it sustainable. When a market is held below its natural equilibrium for decades, the eventual repricing is rarely linear. Oliver's current analysis treats silver not as a cyclical commodity, but as a monetary asset emerging from a generational compression. On both arithmetic and logarithmic scales, the math no longer supports a return to old ceilings. What matters now is not whether silver can revisit former highs, but how violently it overshoots once the repricing process fully takes hold. Oliver's conviction going into 2026 is stronger than at any point in his career. The long-term range that defined silver for 50 years has been structurally breached, and history suggests that once silver escapes these constraints, it does not move gradually. Based on ratio analysis, monetary expansion metrics, and intermarket spreads, Oliver now argues that silver's fair value, adjusted for decades of dollar debasement, is not measured in tens, but in hundreds of dollars per ounce. In his framework, even a move beyond $200 would not represent excess. It would represent catch-up. Under the most extreme, but mathematically consistent scenarios, silver overshooting toward the $500 level before any lasting correction is not only possible, but historically consistent with prior regime shifts. In today's video, Oliver walks through the technical evidence behind that thesis, from silver's breakout against the S&P 500, to its resurgence versus gold, to why decades of monetary dilution demand a radically higher pricing model. We'll also examine the signals he is watching most closely as 2026 begins, why this is not a late-cycle move, and how investors should think about positioning as capital rotates away from financial assets and back toward monetary metals. Stay with us, because this is not a discussion about speculation. It's about structural repricing. If you value deep dives like this, don't forget to like this video, subscribe to the channel, and turn on post notifications for more videos. We appreciate the support and hope you enjoy the video.
Now that top chart shows gold price since 50 years ago, okay? Since it was legalized in the US. And it's priced, it's a price chart only, not momentum, but it's scaled on a ratio basis, a logarithmic scale. So that a move, for instance, the 76 low in gold was just above 100, and by 1980, it reached 850. Okay, that's an eightfold move in price, eightfold gain from bear low to bull high. And lo and behold, if you go back to 2001, gold made a low at about 260, and by 2011, a different span of time, 10-year move, it was an eightfold move, same dimension as the first one on a ratio scale. And then we've started our bull market from the bear low in 2015, which for gold was $1,050 in US dollars. And right now we're only fourfold gain. So when you stand back and look at this and say, well, inhale, exhale, we're only halfway inhaled here compared to the two prior bull markets on a dimension move. So, if gold even went well above 8,000 to get to another eightfold move, it would only be matching the same dimensions it's done twice before in the last 50 years. The difference this time in our assessment is the technicals and fundamentals are far different, far more bullish for gold and for monetary metals than they ever were. Hence, going back to 8,000 would be just a yawn. Oh, we've done it twice before. Big deal. don't even expect 8,000 to stop it. But we're just pointing that out because people think, gosh, if you look at an arithmetic chart of gold, a normal everyday chart, you think, oh my gosh, it's left the page. No, it hasn't. It's only half the dimension of the prior two bull markets. And that's what brings us highly focused now to the chart below that on the same page. Silver, 50 years of silver. Unlike gold, which the 1980 surge was a tenfold move from the bottom of that range to the top, much of it compressed in the last 2 quarters of that bull move. Then it came all the way back down to the bottom of range and duplicated the same thing again in 2011, but it wasn't a new high. Gold was making a much higher high than it made in 1980 when it got to its high in 2011. And yet silver, while it had a big move from the bottom of that 50-year range to the top, it was just duplicating the same price that it was in 1980, 30 years later. So, how come? It moves with gold. It goes up and down with gold. No issue about that. But why couldn't it go up above the high of 1980 like the same dimensions the gold did? Okay, now we've broken out finally. And on this log scale chart, if you did what gold has done twice before, now maybe is doing a third time, if you took the prior move in silver on a ratio scale and added it to the point of, we could be $500, just the dimension of the range. So if you look at a chart in an old orthodox way, a range, top to bottom, what's the dimension? You add that to the breakout level, and that's your swing objective. Well, in this case, you're talking a tenfold move from the bottom of the range to the top. Well, a tenfold move getting above 50 means you could go to 500 just to match the dimension of the ratio moves that have persisted for 50 years. And why has silver been confined for 50 years while most other markets have not? Copper hasn't, lead hasn't, gold certainly hasn't. I think silver's headed now for a new reality. And old notions of what's expensive or what's overbought, throw them out the window. And I think a lot of this move that other arrow I've got plotted there could occur in a matter of a couple quarters. Not that ultimately go to 500, let's say, in a couple quarters, but to easily go to a couple $100. And that's our bet. I bet that sometime by the second quarter, we'll do that. And how do we time that? If you go back a couple pages, I'll show you where we set the clock. Spread charts tell you that. Keep going. More. Okay, now let's go to the top of that page there. No, go one more page even beyond this. It makes another major point. One more page there. This page shows charts that measure the monetary metals, gold, silver versus the stock market, gold versus the stock market, and even the gold and silver miners. But the top chart here shows, going back to 2013, each month we take the close of gold and divide it into the S&P price and express it as a percent, and we plot it. Okay, so these are monthly closes going back to 2013. It's when gold was really collapsing back then. Also in relative performance, it was coming down. But since about 2015, you see the price action, the spread action has basically been either side of 50%, been above it and below it, above it and below it, but sort of really going sort of sideways. So gold's been hanging in there versus the S&P, been doing as well. November's close broke out above that 4-point, very gradual downtrend line that capped off this relative performance chart for 11 years. It broke it out in November. Well, of course, in December, gold had a good up month, while the S&P had a slight down month, I think. The spread went even further in December. But that chart has just now broken through a huge wide base. This is the start of something, not the end of a bull market. This is telling you that the money flow into gold, while it's been very strong over the last few years, was still within the range. And it's only in November that it finally broke out, in December even more so, and said, I'm out of here. What it's telling you is money is starting to shift from the stock market to the gold market. It's actually been going on since 2024 when you were near the bottom of that range. But now it's broken out. So this is effectively a fresh buy signal telling you if you're an investor, should you be in gold or the stock market? It says, yeah, you should be in gold. It's just begun. Okay.
Picking up from the first set of charts, Oliver reframes the gold bull market not as something extended, but as something incomplete. On a logarithmic scale, gold's prior to secular advances both produced eightfold gains from bear market lows. By that standard, today's move is only halfway through its historical dimension. That matters because silver has never moved independently of gold during true monetary cycles. It has always followed and then accelerated. This sets the stage for the second major discussion: silver's decisive shift in relative performance. Oliver shows that silver has not only broken out in absolute terms, but has now turned decisively higher against both gold and the broader equity market. These relative breakouts are not lagging indicators. Historically, they have marked the beginning of silver's most explosive phases, not the end.
Silver versus S&P. Also in November, it broke out over a similar basing pattern and relative performance to the stock market. That arrow shows where it was in November. Look at the December close. Whoosh, even further. So silver has also said, I'm out of here, freshly so, versus the U.S. stock market. This is not a late signal. This is an early signal. And then scroll down one more, surprise most people here. This is the gold and silver miners via the XAU index, which includes gold and silver miners. It's done the same thing. It broke out in November, gained more in December of a base of performance that's defined by 1, 2, 3, 4 peaks hit that red line before you broke out. So each of these charts are telling us that the monetary metals and their miners have only just shifted trend versus the U.S. stock market. It's a fresh buy signal telling you if you're going to reallocate now. You're not late in terms of the asset class shift. So these signals should not be occurring if, in fact, as the skeptics think, we're at a top in the monetary metals. This should not be occurring. These guys should have broken out years ago and been at some peak a couple years later. Then maybe we could talk about a top. This just began. So this is a smack in the face indicator that tells you, no, don't believe in the skeptics. Anyway, these are important. Go to the next page again, and we'll look at that other chart, which shows, okay, let's say you're in the monetary metals, whether you own bullion or mining stocks or ETFs on silver or gold, whatever. Where do you emphasize your long position within the monetary metals? Yes, over recent years, gold has been a better place, but that just changed. So not only did silver and gold break out versus the S&P, but silver has broken out of a decade-wide basing range versus gold. It's saying, I'm coming out of here. I'm going to beat you, gold. Now, the reason this is important is not just that the shift has occurred freshly, but that whenever this shift occurs, like this chart you're looking at here, a similar event happened back in summer of 1979. In the next 5 months, almost 2 quarters, silver quadrupled in price, not just beating gold, but quadrupled in net price in 5 months up to the 1980 January high. A similar pattern occurred in September of 2010. Silver had already been in a bull trend, so had gold. But at that point, silver suddenly broke out versus gold. And in the next 7 months, so about 2 quarters, it doubled and a half in price. Okay, this just broke out. So we set our clocks here and say, listen, we've learned in the past, and there's other examples of this, where when you do this kind of breakout, give it a couple quarters and you should see a gush in net price. Now, maybe it goes further, but the gush part, the extreme change, occurs literally in the next couple quarters after the spread breaks out. The spread just broke out. Don't expect a top or any sort of topping action or even a corrective action of significance until we get into the second quarter. And this spread isn't going to be where it is. Now, scroll down, you'll see some examples of where silver has been. Right now, it's at 1.6% of the ounce of gold. What we do here is we divide silver ounce into an ounce of gold, express it as a percent. This shows 50 years. What was the peak spread reading on a percentage basis of silver price versus gold going back to 1975? Well, you get that red horizontal line is at 2%. And you can see that in 20 years, in the past 50 years, silver's at least been 2% or higher. Well, right now it's 1.6. And we just broke out over the last 10 years of highs, that little green line, which we showed closer up on the chart above. He just broke out. If you even just go to 2%, I mean, that's a huge move from 1.6 to 2 on a ratio basis of silver versus gold. But we're in a bull market. And when you go back and look at the bull markets in net price of silver and where the spread was then, look at that 79 peak when it was gushing to the upside to the early 1980 high in price. The spread was at 6.5%. And then go to the 2011 high when again silver rushed up to 50 within the old price range. The spread was over 3%. Well, right now at 1.6, just to get to the spread level that we saw in 2011, you got to like double silver's performance level that it currently exists at. And since we're in a bull market, I would tend to think that one, that 2% level is not going to be resistance. Instead, it's going to go up and challenge, perhaps even take out the performance highs it saw at the two prior bull markets, the one at over 3% and the one over 6%. Don't be shocked. But that just shows how cheap silver still is, despite the recent breakout on that chart above. We took out 10 years worth of highs. You're still cheap. And I think silver's new reality in price is also going to be reflected by a new reality in its relative performance. So again, we have fresh signals here that say, hey, it's only begun. Quit talking about a top. You're not anywhere near a high of any kind, and it just broke out, so if this were a price chart and I just broke out over that ceiling with the green line there shown on the chart above, it's a fresh breakout. Yeah, it looks like you've been chasing silver because silver's up there, but silver only just also broke out above its old stupid price highs, $50, $50. So it's not really, even if you took an arithmetic price chart of silver and you measured from lows that were $4 and $5 during the last 50 years and highs that were both at 50, you've got, like a $50 range there almost. Well, add 50 to 50, the breakout point, you got 100. So even on an arithmetic scale, silver should just go to 100 just to match the simple arithmetic scale. But I'm arguing on the log scale, it's likely to do that. And also reprice itself fairly versus its real dollar value. Remember, you look at an M2 chart and look at the massive increase in the money supply since 1980, or even since 2011. And if you try to match silver to simply match the decay in the real buying power of the US dollar, silver be in the hundreds.
The most important takeaway from Michael Oliver's work is that silver's breakout is occurring simultaneously across multiple dimensions. Price alone can be misleading. What matters is relative strength, silver versus stocks, silver versus gold, and monetary metals versus financial assets. In every case, the signal is the same. Capital is rotating. These kinds of shifts do not happen at market tops. They occur at inflection points when institutional money begins to reassess long-term risk rather than chase short-term returns. Monetary debasement sits at the center of this thesis. Since 1980, and especially since 2011, the supply of dollars has expanded at a pace that fundamentally alters what historical price levels mean. A silver price that once represented excess now represents suppression. When Oliver overlays silver's price history against M2 expansion, the conclusion is unavoidable. Silver has not merely lagged inflation, it has ignored it entirely. Repricing does not require optimism, it requires arithmetic. When purchasing power erodes, nominal prices must rise to compensate, or the market remains misaligned. Equally important is silver's behavior versus gold. In prior bull markets, when silver decisively broke out on a relative basis, the response was swift and disproportionate. In 1979, silver quadrupled in a matter of months. In 2010, it more than doubled. Today's breakout mirrors those setups, but with one critical difference. The macro backdrop is far more fragile. Sovereign debt levels, currency debasement, and financial leverage are orders of magnitude larger than during previous cycles. That suggests the response may not only be faster, but more extreme. Oliver's projection toward $200 and potentially far beyond is not framed as a terminal high. It is framed as a phase, a violent adjustment following decades of constraint. Even a move into the hundreds would not exhaust silver's long-term potential if relative performance continues to normalize toward historical extremes. When silver trades at just 1.6% of gold after breaking out of a decade-long base, the argument that it is expensive becomes mathematically incoherent. As we move deeper into 2026, the message from these charts is clear. This is not about timing a top. It is about recognizing the early stages of a secular shift. The old assumptions about valuation no longer apply, and investors who wait for comfort may find that the repricing phase does not pause to accommodate them. If you found this analysis valuable, make sure to like the video, subscribe to the channel, and share it with others who are watching the monetary metals space closely. Thank you for spending your time with us, and we look forward to continuing this conversation as this extraordinary market evolution unfolds.